Welcome back, A-star candidates. You're tuning in to the ultimate explainer from Module 10, Invoices, Debit, and Credit Notes. Now look, we're skipping the basic fluff today and diving straight into the deep end. This isn't just about simple record keeping. It's a masterclass in high-level financial intelligence. We're going to focus on the exact strategies, the examiner secrets, and the advanced technical methodologies that literally separate the A-star students from everyone else. So let's get into it.
Here's our strategic roadmap for today's session. We'll start with the A-star conceptual blueprint, move into mastering technical execution, tackle AO3 evaluation and ratios, dive deep into the examiner's playbook, and wrap it all up with the pause and think challenge.
All right, starting off with part 1, the A-star conceptual blueprint, building the foundation. So Cambridge has fully transitioned to modern international terminology for the upcoming syllabus updates. Listen, the term bad debts is officially out. Irrecoverable debts is in. Capital is evolving too, so you really need to get comfortable using owner's equity. As an examiner, I can tell you we demand 100% accuracy here. Using those outdated textbook terms? Yeah, that's going to cost you marks. Using precise, modernized language proves you're actually operating at the level of a modern financial professional.
Now think of the accounting equation like a perfectly balanced scale. Every single transaction you process, from an invoice or a credit note, possesses duality. If you impact one side, well, you absolutely must impact the other, or at least make a corresponding shift on that exact same side. If your scale tips even a fraction, your trial balance fails. Maintaining this delicate balance during the fiscal period is really the ultimate test of your grip on the business entity concept.
Okay, here is a severe warning straight from the marking room. So many candidates fall into this catastrophic trap when valuing what goes into that equation. They constantly overstate their profits by just ignoring potential losses, which, as you know, is a blatant violation of the prudence concept. When you're assessing credit notes or deciding if a debt is truly irrecoverable, never ever anticipate revenues but always account for potential liabilities. This is what guarantees the rock-solid integrity of your financial reporting.
Moving on, you've got to seamlessly weave core concepts like accrued, prepaid, realization, and consistency into both your written coursework and your exams. Guys, it is simply not enough to just memorize flashcard definitions anymore. We actually expect you to use this specific vocabulary to justify your procedural logic. You have to be able to explain exactly why a super complex transaction was recorded a certain way to satisfy banks and tax authorities.
Moving right along to Section 2, Mastering Technical Execution. Welcome to the engine room of double entry.
So your procedural logic needs to flow exactly like this. It all begins with the source document. That's your raw evidence. From there, it flows directly into the books of prime entry, and finally, it lands right in the T-account ledger. Think about modern fintech for a second. Today, AI-driven accounting software like Xero will automatically extract data from an invoice and draft the entry for you in milliseconds. But here's the catch. The software only handles the mindless data entry. You have to provide the financial intelligence. As examiners, we are testing your understanding of this underlying procedural logic to make sure you can actually verify and troubleshoot the double entry yourself.
Now listen closely to this next part, because this right here is your ultimate safety net. Method marks are awarded even if your final balance is totally incorrect, provided that your logical flow is clearly visible to me, the examiner. You literally have to show your workings. That means if you make some tiny, silly calculator error on an invoice total, but you carry that wrong number correctly through the prime books and into the ledger, boom! Advanced technical methodology dictates you still secure those method marks, so please, map it out clearly.
Let's break down the gold standard for T-account structures. Balance brought down versus balance carried down. Distinguishing between these two is an absolute necessity if you want a perfect trial balance. Remember, the balance carried down closes the period. It acts as the plug. The balance brought down is what opens the new period on the exact opposite side. Reversing these is a classic panic-induced exam mistake that will completely ruin your procedural flow. Honestly, do not let it happen to you.
Another huge pitfall we see all the time is miscalculating percentages between trade discounts and cash discounts. Keep them straight. Trade discounts happen at the point of sale for bulk buying, right? So they do not appear in the double entry. Cash discounts happen way later as a reward for prompt payment, and those absolutely must be recorded. Here is a rapid-fire memory hack for when that exam pressure hits. TBC, trade before cash. Always calculate the trade discount first to get your real invoice total, and then calculate the cash discount on that remaining balance. Trust me, TBC will save you from a cascading mathematical disaster. All right, let's step it up a notch with Section 3, AO3, Evaluation and Ratios. We're looking beyond the numbers.
Consider a current ratio taking a nosedive from 2.5 to 1 down to 1.1 to 1. If you just write down that liquidity worsened, congratulations, you get the most basic marks possible. To grab that A star, you must build the full cause and effect chain. Why did it drop? Is there too much inventory just sitting dead in the warehouse? Are trade payables being settled way too slowly? Or maybe some massive capital expenditure just completely drained the cash reserves? You have to literally play detective with the invoices to tell the real story of what's happening.
And this exact detective work is why inter-firm comparisons require intense critical analysis. Remember, different businesses use totally different accounting policies. Let's say one business uses straight-line depreciation while its competitor uses the reducing balance method. If you're trying to compare their profit margins, you must analyze the true quality of that reported profit. A business using reducing balance is going to show lower profits in its early years compared to straight-line, even if their underlying real-world cash flow is exactly the same.
An elite accounting student knows that the ledger simply doesn't tell the whole story. You've got to evaluate the crucial non-financial factors too. Things like staff morale, physical location, and overall market reputation. Sure, you won't ever find an invoice filed away for a good reputation, but if your accounts payable department is constantly late paying suppliers, yeah, that reputation is going to tank fast. AO3 investigative skills require you to connect the dots, bringing your answers back to how these dry financial decisions impact real-world non-financial factors and long-term business sustainability.
Okay, let's unlock Section 4, the Examiner's Playbook. This is all about securing maximum marks. I'm going to rapid-fire some definitive examiner do's and don'ts, so pay close attention. First, maintain clear handwriting in your ledger accounts. If I literally can't read your balance carried down, I can't mark it, period. Second, as we said, show all your workings to secure those method marks. Third, manage your time strictly by question weightage. Don't spend 20 minutes on a 2-mark question. And you want to know the most devastating way to lose marks? Failing to distinguish between revenue and capital items. So remember this mnemonic trick. CARE. Capital adds to assets, revenue is expense. Just remember CARE and avoid that fatal error. Finally, we arrive at Section 5, the Pause and Think Challenge. Time for the A-star integration.
Here is your high-level, multi-layered prompt to take away today. If a business overstates its inventory valuation while its current ratio suddenly drops to 1.1 to 1, which accounting principle is being violated? And, taking it a step further, how might non-financial factors like their reputation completely suffer when the tax authorities inevitably intervene? I want you to map out that entire cause and effects chain. Go ahead and pause this explainer to really test and prove your A-star capability. Thank you so much for joining me today. Keep applying that sharp financial intelligence, and I'll catch you in the next one.